Which select technology stocks are worth investing in? Is China a big risk or a big opportunity? Why is gold and the metals rallying so hard? Hang on. This is not financial nor professional advice. This video is for entertainment only. It's once again come time to trade the rally. We've been through this many times before. We hope it doesn't end the same way, where the rally grows and then it fizzles out. But there's select technology stocks that have been doing good in spite of these ups and downs. So those are the first things I'm going to talk about. Then I'm going to talk about China and their effect on the world and commodities. China is projected to grow from 4 to 6% next year, which is good in the current world situation. They've lifted their restrictions on health, and made travel more possible, and it's opening up to the point where they're going to continue to rally. Because they are rallying, because their economy is growing, there's also going to be a call for metals and commodities in general, and that includes gold, which I'm very bullish on right now. There's going to be a war between commodities and the Fed. As the Fed raises interest rates, commodities will go down. Okay, but it depends on how much the Fed raises rate and how fast they raise the rates. And so we have a time here where they can be traded and you can make money on them, especially gold. And there's other factors with gold. The fact that Russia and China are buying so much gold and trying to give an option to the petrodollar so that they get a better exchange rate when oil is bought. And so other countries want to do this too, and Saudi Arabia is joining in on it. So they want to make the Chinese currency, the yuan, they want to make that an alternative to the dollar. And as part of doing that, they're building up their gold reserves to build up their currencies. So it's a favorable environment, especially for gold. It's a favorable gold for commodities in general. And you've noticed that oil has gone up from the mid-70s now to the mid-80s and probably is projected to keep increasing. And that's because the dollar keeps going down. And as the dollar goes down, commodities will increase in value. And that's why the Fed's going to be forced to increase interest rates and keep increasing rates so that the dollar doesn't go down too much, because the more the dollar goes down, the more inflation we will have. So you can say this stock rally and the dollar going down is going to lead to a rebound in inflation, and the Fed knows this from the 1970s. They're not going to pivot. I don't think they're even going to stop. I think they're going to be forced to keep increasing. It might be smaller increases at a time. They might do 0.25% at a time. But I think with commodities increasing, and especially if oil goes above $100, you're going to get back to those half-point increases. And I think 7% interest is in the cards. But we have this time for now where there's select technology companies that want to take off. And there's many companies that want to take off, and they're being held back by the Fed, and they're rising in spite of the Fed. We're not in a recession. The Atlanta Fed is projecting that our fourth quarter GDP is going to be 4.1%. that's pretty decent compared to what our gross domestic product has been. We're not in a recession now. And I think the Fed keeps trying to push us towards a recession, to having a mild recession, and we're not having it. So this reminds me so much of the 80s, where it was a battle between the interest rates, the Fed, and the economy, which wanted to take off, and the economy eventually won. Okay, and that's why I think you're seeing this rally in spite of the Fed. We have a healthy economy that wants to go forward and would literally rocket ship into the atmosphere and send us into hyperinflation, which the Fed knows is the main danger right now, and is going to keep increasing rates. And I think we're going to end up with 7% rates. But let's look at the stocks that are worth trading. And we'll start off with our select technology stocks. My favorite stock symbol is ACLS. That's ACLS for Axelis Technologies. And they make semiconductor equipment. And semiconductors themselves have been showing sort of an uptick. But this makes the semiconductor equipment so that they can make semiconductors. It's done nothing but insisting on going up the last 3 months. And its price to earnings, its trailing price to earnings is about 20. Its forward price to earnings is 19. Its earnings growth rate is about 28%. It's about a $3 billion market capitalization, so there's plenty of room for growth. And like I say, it just keeps going up. I'm a trader, and I would like to sell it, but it keeps going up. So what I'm forced to keep holding it during these uncertain times. And I'm happy to keep holding it when a rally is going on, especially. The next stock is Super Microcomputer. Its symbol is SMCI. They make all manner of computer equipment, especially servers, and they've been a very profitable company as we look at the chart over the last year. They've come down a little bit. They were in the 90s, and they've come back down to about 80. Its underlying value is about 120. Okay, that's because they have this outstanding growth rate of 42%, a 42% growth rate. Their trailing price to earnings is 10, but their forward price to earnings is only 8. So this has been, I thought, somewhat of a speculative company, but I love their outlook. They try to do everything faster, better, and greener. It's like you get twice the speed for half the amount of money and half the amount of energy used. It could be their goal. China is reopening, and they've stopped their lockdowns to a large extent, and are opening up their economy to travelers and so forth. So it's likely that the Chinese economy is going to expand dramatically. And so I'm going to triple leverage it by using the fund YIN, YINN. And that's a triple leverage bullish fund on the Chinese index. For every dollar it goes up, you make $3. So I'm going to play this. The Chinese stocks have taken off since the beginning of the year. It looks like they're past the worst of it, and this is more or less trying to be near the bottom and going up. And looking at the chart, you can see the 5-year chart, how dramatically it's come down, okay? And I'm expecting it to spring back upwards and maybe go from below 100 to over 500. So it's a potential 5 times trade here. It is risky, but I'm treating it like a day trade in some extent, but I'll ride it out longer if it turns out positive. Commodities have been going up as the dollar has been going down, but gold has a special oomph because Russia and China are buying lots of gold to strengthen their currencies. The plan, I think, is to make the yuan an option to using the dollar to buy oil. They want an end to the petrodollar so they can use a weaker currency, the Chinese yuan, so they get a better exchange rate when other countries buy oil. And Saudi Arabia is open to this idea. So they've been buying a lot of gold to strengthen their currencies, and mainly the yuan, and it's mainly China buying gold, although Russia is buying gold also. So the way I'm playing this is to buy NUGT. NUGT is a double leverage bullish fund on the Gold Miners Index. For every dollar that the Gold Miners Index goes up, you make $2. And as you look at the chart, you can see that it was down earlier in the year, and now it's starting to recover, and I think it has quite a ways to go up. So I think we're going to get some springboard action, and so I'm playing NUGT as probably a long swing trade. My next stock is Caterpillar, which is CAT, CAT for Caterpillar. And it's part of the industrials, it's part of the Dow Jones Industrials, and the Dow Jones Industrials have been doing better and are probably safer investments as we come to determine whether this rally is for real. The industrials have been doing better. So it's safer in that way. It also benefits from the infrastructure bill. Caterpillar makes heavy equipment. They make some farm equipment, but they're mainly heavy industrial equipment, the type of equipment that's used in mining. So that's going to expand. So they're benefiting on a lot of fronts. The industrials being safer, infrastructure. The infrastructure bill that was passed was massive and goes out 10 years. And then we got the mining stocks, the metals, and gold all going up. So Caterpillar's sure to benefit from all of that. And looking at the chart, you see that it's at a high point, and its price to earnings is about 18 on a trailing basis, and on a forward basis is around 17. And its earnings growth is at 19, which is very good. So this is a safe stock, and you always want to have some of those in your portfolio. So I intend to invest in Caterpillar. Another favorite of mine is CSIQ, which is Canadian Solar, which makes the solar panels, and it's going to lead us into the greening of energy, hopefully. All the solar companies have been taking off to some extent since the beginning of the year. As you look at the chart, you can see it's gone from like $30 to $43, and its market cap is about, it's getting close to $3 billion. So it's a substantial company, but there's plenty of growth ahead. And its trailing price to earnings is 15, but its forward price to earnings is 10. So I think you're getting it at a bargain price, and it has a very solid earnings growth of 29%. So it's making money. It's kind of, people doubt the solar stocks, but we need energy, and we need it from wherever we can get it. And solar is, of course, part of the answer. It's not the whole answer. We need some nuclear. We need oil, probably always, to some extent. but it's part of the solution. I think it'll be a big part of the solution. I mean, let's put solar on buildings. They're taking up space anyway. That's just wasted space and wasted energy. And you're preserving the building. Because people don't think about this, but the solar panels, especially like in a hot climate like Arizona, where the roofs get like 140 degrees, having that shadow effect from the solar panel really saves you a lot of energy. So for the southern part of the United States, it's a definite part of the solution. And as you can see from the chart, it's taken off, and I think it's going to continue to go up, especially if the price of oil takes off. Semiconductors have taken off from the beginning of the year, and one of the safe choices in semiconductors, in my mind, is TSM, which is Taiwan Semiconductor Manufacturing Company. And I like this stock probably because they're building 2 factories in the Phoenix area. So that takes away some of the risk of there being in Taiwan if China would invade, that they already have 2 factories going in the United States. And I think hopefully that the Taiwan invasion never occurs, and that the United States and China can come to some agreement on this. But I think we do have an escape hatch in there, having increased factories in the United States, and that's probably going to continue. And especially if the Chinese start rattling their saber too loudly, that's probably going to be more and more the trend. So I see it as relatively safe. It has a PE of only 15. That's both forward and trailing. PE is 15. And they have an earnings growth rate of around 23%, so that's very solid. And they're a huge company. They're $450 billion. And another factor that adds to the safeness of it probably is that Warren Buffett owns a good part of it. So looking at the chart, you can see that it's taken off since early in the year. And this is a huge company with semiconductors generally taking off. And I think we can play the swing and possibly keep it as a long-term play if this breakout of the S&P 500 continues to hold. We will have to see on that. But I would like to hold on to this. I see this as relatively safe if you want to play the semiconductors. So that's the way I roll. That's my story. Thank you for listening and watching. Be sure to smash the like button. Be sure to subscribe if you haven't already done that. Hit the notification bell if you want to be notified of future videos. Good luck to us all. I think we got a rally going here that could continue for a while, and we got to play the rallies. And I see that as being the worst case scenario, is that we continue having to play the rallies upwards and play it going downwards too, which you can do with inverse funds. And I'm so happy I have that option. But I think if we get a solid breakout here, it reminds me of the 80s. I think the Fed's going to keep trying to hold down an irrepressible economy, and hopefully that scenario works out. It worked out in the 80s, and it could work out now. Thank you.